and the bottom is going to drop out of the subprime market. And of course, the subprime market is at the margin determining home prices. It's these buyers who are lying about their income, who are overstretching themselves, who are coming in here, and it's been made possible through this credit market where the buyers of these instruments are somehow believing they're insulated from losses, and people were willing to buy these risky tranches. Once they don't want to buy those tranches anymore, you're going to start to see a big drop or a big rise in interest rates, and that whole market is going to shut down. Because all of a sudden, when the mortgage people who are buying these bonds from you guys, when they can't resell them because Goldman Sachs and Morgan Stanley won't buy them anymore because they can't sell them, then it's over. There's no more market. There's no more secondary market for these products. And credit really starts to contract. And it's almost like a self-perpetuating spiral, because the minute you take away the credit and you make it harder for people to borrow money to buy property, well, you have fewer buyers. Of course, a lot of property is going to be coming on the market over the next year or two, because, as I said, when these adjustable rate mortgages reset, a lot of people are going to be in a situation where they can't make these payments. Even if they cut back everywhere, they can't make these payments. And of course, a lot of them are going to be unemployed if they happen to work in the service sector and they've lost their jobs because other people have cut back. So a lot of properties are going to come on the market. If you think there's a high inventory now, wait a while. Who's going to buy these properties if there's no credit flowing? And besides, everybody already owns houses. I mean, we have home ownership right now is at an all-time record high. You know, there's never been more people that own homes. I mean, look at all the homes that are bought by single women in their 20s. You know, it used to be back in, I don't know, 10 years ago, 15 years ago, if two people got married, they were both renters. And they got married and they bought a house. Now two people get married, they're both homeowners. They got to sell one of them. You know, the whole dynamic. And one of the reasons this downturn is going to be particularly severe, right, when people are stretched to the limit on their mortgages and they have no savings. You know, back in the 1950s or 1960s, a guy lost his job. It wasn't a big crisis. You know, he had a stay-at-home wife. She can get a part-time job. He can get a part-time job. They had plenty of savings. They had a fixed-rate mortgage. I mean, it wasn't adjustable. They could get by. No big deal. It wasn't a crisis. Today, most people who have a home, you've got two breadwinners. And even if one of them loses a job, they're done. They can't make the payments. The only reason they were able to do it before was because, okay, they borrowed some more money. They went to that ATM and extracted some equity. But all of a sudden, when you can't do that, and a lot of the people who bought homes, I used to laugh, all the people would be buying these adjustable rate mortgages. And they'd be asking a survey, well, why are you buying an adjustable rate mortgage? Why don't you get a 30-year fixed? Well, I'm only going to live in a house for 2 or 3 years. Well, I would think, well, then why are they buying it? I mean, if you're going to live in a house for 2 or 3 years, just rent. Well, they were buying it because they were speculating. They said, I'm going to buy this house, it's going to go up, but I'm going to sell it in 3 years. Well, what happens when it doesn't go up? And what happens when the mortgage interest rate now resets and you can't afford it? Well, you just walk away. In fact, what a lot of people didn't realize, and I used to read a lot of articles about all the risks of nothing down mortgages and zero down mortgages. And I would say, yeah, you're right, there are a lot of risks, but the papers had it wrong. The risks weren't being borne by the borrower, they were being borne by the lender. That's the whole idea. When you put nothing down, you got nothing to lose. It's the lender that's taking all the risk. And of course, when you give somebody that situation, where you tell somebody, hey, you can buy this house for $500,000. You can lie about your income. You can put nothing down. And if it goes up, it's all yours. That $2 million bucks, yours. You can borrow it out tax-free every year, it's all your money. And if it goes bad, just move out. You have nothing to lose, especially if they took a negative AM, teaser rate, adjustable rate mortgage, where for the first 2 or 3 years, the mortgage payment was really low. It might have even been lower than what they were paying in rent. And so they figured, what the hell? In fact, for a while in California, it was much easier to buy a house than rent, because renters, the landlords were, they wanted you to prove your income. The lenders didn't need you to prove your income you can't have a stated income rent. They always do a credit check. They always check on your stuff. Landlords wanted first month. They wanted last month. They wanted a security deposit. Hell, you didn't need any of that to buy a house. So, I mean, a lot of people are just making this gamble because we put that in their minds. Of course, this is all going to unravel. This is all going to unravel. And as real estate prices start to fall, right, and you say, wait a minute, you know, when they rose, look what's happened to real estate prices. I mean, what have they done? I mean, when people talk about, oh, we've created all this wealth, I mean, Barry mentioned all the wealth that we've created. We really haven't created wealth. What's happened is the value of our assets are now appraising at a higher price. But prices can change over time. The NASDAQ was 5,000, then it was 1,000. The stocks were still the same stocks. The perception of the value is all that changed. So the reason that real estate prices were so elevated was supply and demand, right? Everybody wanted to buy, and nobody wanted to sell. Why would you sell a house? It just kept going up. If you needed money, just borrow against it. And everybody wanted to buy because it was your ticket to Easy Street. If you were renting, you were an idiot. You were throwing away money. You got to buy. So everybody wanted to buy, and nobody wanted to sell. So prices went up. Well, what's going to happen? All of a sudden, nobody wants to buy anymore. Who wants to buy houses when they're falling in value? Who wants to lend money to buy houses? You see, when real estate prices were rising, the lenders didn't care. Default, who cares about default? If the guy defaults, we'll sell the house and we'll make a profit. But when prices are falling and lenders are worried about defaults, they're going to contract their lending. I'm not going to lend money out. Nothing down. Are you kidding me? You know, I need 20% down. Of course, when you require a down payment, it makes it much more difficult for someone to buy a house, especially when the prices are so high. You know, if the average house is $500,000 and now you need $100,000 down, the average guy doesn't have that money. It was the fact that they abolished the down payment that made so many people able to pay these prices. In fact, there was a whole lending industry constantly lowering their standards and lowering their standards, which enabled prices to rise. Historically, the lenders provided a check on home prices. And if you look at a chart, you go back like 100 years, and you look at the price of houses in the United States until 2000, it matched the CPI. That's basically all that happened is housing prices basically stayed even with the CPI, but only because the owners of those houses spent a bunch of money every year maintaining them. If you didn't maintain it, if you didn't fix the roof, if you didn't fix the pipe, if you didn't do all that stuff, your house lost value. It was only because you kept it current and you maintained it that it kept pace with inflation. It wasn't until 2000 it went off the charts because something weird happened. And this is all going to be corrected. This is all going to be corrected. But also, you know, when pendulums swing, they don't swing way to one side and then come and stop in the middle. They go all the way to the other way first. It takes a while before you find a balance. So as expensive as real estate got, right, that's how cheap it's going to get. People are going to be completely amazed at the prices that houses are going to be selling for in a few years. Amazed. Just as amazed as the people were when they saw their shares of stocks go from 200 to nothing or practically nothing. It's the same thing. It's the same dynamic because you're going to have lots of sellers. You're going to have very little buyers. You're going to have a lot of foreclosures. You're going to have a lot of developers going bankrupt. You're going to have a lot of speculators. You know, I know lots of people own 5, 6, 7, 8 houses. You know, maybe they've had negative cash flow on these houses. Their negative cash flow is going to get bigger because a lot of them are refinanced with adjustable rate mortgages. You know, I know people who own many, many houses, and when they qualified on their loans, they wrote owner-occupied. I mean, there are people that have 7 or 8 or 9 owner-occupied homes in different states. I mean, everybody is looking the other way at these speculators buying houses. But, you know, they're all going to come on the market. Look where we are here in Las Vegas. I mean, there are so many condominiums that have been built in this town that nobody lives in. Their lights are never on. I mean, they weren't even bought with the intention of living in them. Some of them are so small, it's like nobody would even want to live. Why would you even want to buy a condo in this town? Look at all the hotel rooms. And they're pretty reasonably priced. Why would you want to own a condo? Well, the only reason people wanted to buy condos was because they thought they can flip them to somebody else. But as this huge supply of houses comes back on the market from speculators who got caught, and a lot of people who are speculators are homeowners. Just because you own your home and live in it doesn't mean you're not a speculator. If you bought a house using an adjustable rate mortgage, knowing that you can't afford to make the payments when they reset, you're a speculator. If you bought a house planning on selling it in 2 or 3 or 4 years, you're a speculator. That's all you are. So we had rampant speculation in this housing market, much more so than we had in the stock market. But the bigger problem is how intertwined the economy and the stock market are. Because if you look at that house